Hello everybody, welcome back to another valuation investing video, and today in this video I'll be going over Intuit stock, in which they just recently had their earnings report. As we can see, in their last trading day they were down 5% after that earnings report. The past 5 days it's down 8%, and in the past month it's down 15% when the market's actually up. So this company's underperforming right now. Year to date it is up 6%, nearly about market average, but in the past 5 years it has been up 91%, but all time it has really outperformed the market. So right now we can see Intuit stock is at a pretty decent dip. So with that being said, I'm be taking a look at Intuit stock and looking at the financial health of this company, also taking a deeper dive into their earnings report, then finally using my intrinsic value calculator to get a fair value price for Intuit stock. So first, let's take a look at what Intuit does and what products they have. So for the first, they have for consumers, where they have TurboTax and Credit Karma, where TurboTax is Intuit's most well-known product for individual tax preparation. It helps people file their federal and state income taxes, offering different versions for various needs. Also, Credit Karma is a personal finance platform that provides free credit scores, credit reports, and tools to help consumers monitor their finances and find financial products. So that is the products they have for consumers, but then they also have ones for small businesses and the self-employed, like QuickBooks. This is a comprehensive financial and business management platform for small businesses. It's the central hub of Intuit's business offerings and includes QuickBooks Online and desktop, QuickBooks Payroll, QuickBooks Payment, and Commerce. So they also have MailChimp, which they just recently acquired, an email marketing and automation platform that Intuit acquired to integrate marketing tools directly into the QuickBooks ecosystem. Also, they have for accounting professionals Pro Connect. So this company is pretty diversified with some of their products, as we can see right up here. They do have some good products. They don't have a whole lot of products, but they do have a decent amount where it's not just one product, so they're slightly diversified. But taking a look at Intuit's recent earnings here, we can see they reported $2.75 and $3.83 billion in revenue in the quarter ended July 31st. So with that being said, analysts expected $2.66 and sales of $3.74 billion. So they did beat on both the earnings per share and revenue, which showed earnings increase 38% and sales rise 20% year over year. So this looks very good for Intuit. But the problem is, Intuit did have a pretty bad forecast, where they adjusted forecast was $3.08 and sales of $3.76 billion. So they're actually expecting the sales to be less than it was this last quarter, but they expect earnings per share to go up, probably because of increased profit margins. As we can see, it is basically the midpoint of its guidance for what analysts did expect. As we can see, they earnings of $3.07 and $3.8 billion for the fiscal first quarter. So it's basically the reason why the stock was down, because it came in line basically with what analysts expected for their guidance, if not a little bit lower. So that's the reason why the stock did go down about 5%. But as we can see, for the full year fiscal 2026, Intuit predicted adjusted earnings of $23.08 a share on sales of $21.09 billion based on the midpoint of its outlook. Analysts had been expecting earnings of $23.02 and $21.1 billion of revenue. So they're actually slightly less on the revenue, but slightly more on the earnings per share, which shows us they're probably expecting profits margins to increase a little bit more than what analysts expect. But obviously the sales will slow down a little bit more. But as we can see here, Intuit has a reputation for giving conservative guidance, so keep that in mind. But why is Intuit down? Obviously, we just saw the weak guidance and also softness in key products. Intuit noted specific weaknesses in its MailChimp marketing platform and a decline in average revenue per return from its TurboTax filing software, so that's a big problem. Also, investor reaction. Despite beating analyst expectations, investors focus on the cautious future guidance. So that is the main reason Intuit was down. Taking a look at Intuit's moat, I think Intuit has a pretty big moat, which means they have a good competitive advantage, and basically, I don't think a company can really disrupt Intuit that much. As we can see here, financial data lock-in. Once a small business uses QuickBooks for its accounting all of its financial history, invoices, payroll, and tax information is stored there. So trying to move that data out of Intuit would be a lot harder and time consuming, which is why this is a pretty good moat, because once you use Intuit, basically you're there forever unless you really want to get out, and it takes a long time, but it's very hard to get out. Also, trust and brand power. People trust this company a lot. Also, network effects. The more small businesses use QuickBooks, the more accountants learn how to use it. So this makes the software more attractive. Also, integrated ecosystem. Intuit has built a platform where its products such as QuickBooks, MailChimp, and Credit Karma work together seamlessly. So this is good for Intuit. Taking a look at the financial health of Intuit, these are the 7 key metrics that I like to look at, and as we can see here, we get 6 out of the 7 key metrics. The first 2 have to do with the valuation of a company, price divided by the earnings per share. So all I want is the PE to be positive, which means that they're a profitable company and they're making money, so obviously that is a check mark. But keep in mind, the market trades at about a 25 PE ratio, which means you're paying about $25 for $1 of earnings per share in the S&P 500. But with Intuit, you're paying $48. So you are paying a lot higher premium for Intuit. Just keep that in mind. Not saying this means you shouldn't be buying the company, but it is a little bit higher valuation than the market. But the forward P ratio is actually pretty decent at 29, which I want it less than 30. So with this big difference in normal P ratio and forward P ratio, this shows us that the future earnings per share is actually expected to be a lot better than what it is right now, because this is just meant to be a lot better. If a forward P ratio is a lot lower than the trailing P ratio, that means they're expected to grow that earnings per share very fast. Also, revenue growth and earnings per share growth is there. 19% revenue growth, but 12% earnings per share growth. Normally, you want to see earnings per share growing faster than the revenue, but it is still growing at double digits, so it's not a huge deal, but this is likely because of profit margin problems, which we will get into that a little later, which they are decreasing profit margin by a little bit because of their new acquisitions. Also, they are diluting shareholders, as we can see, 1%. So in reality, this is mainly because of decreasing profit margins mainly, but also increasing shares. Because if you increase shares, that means you're actually going to get less earnings per share. So that's why we want to see shares outstanding going down. As we can take a look here, and as we take a look here, the shares outstanding over the past 10 years have technically gone down very slightly, but over the past 5 years, it has slightly increased. So that is a problem with Intuit. So that's the one thing I don't love about this company, but they're not diluting that crazy, so it's not too bad. Debt to equity ratio seems pretty low at 30%, so their balance sheet looks pretty decent. Also, analysts do expect them to grow at about 13%. Taking a look here at growth estimates, we can see revenue, they're expected to grow about 13%, EPS 13.5%, so pretty good growth for the future still, and basically what they've been doing in the past. So this looks pretty decent for Intuit, but let's get into my intrinsic value calculator. Let's go right over here to my intrinsic value calculator to get a fair value price for Intuit stock and to see what price I'd be willing to pay for Intuit. First, for the bear case, I think for the bear case, this company could grow at 8%, honestly. Now for the base case, let's say for the base case they grow at 12%. Bull case, say they somehow grow 16%. They have been growing 19% in the past, but I expect this to slow down a bit, but I think this is pretty fair for Intuit. Now for the profit margin. Going over here to the past profit margin, we can see it has actually been decreasing since 2020 from 25% now at almost 20%, but they have been starting to increase it. The main reason for this, I have looked it up, is mainly because of their acquisition of MailChimp, and it's starting to decrease that profit margin, but they're starting to get it back, so this isn't looking terrible right now. So bear case, let's say bear case, let's do 17% for the profit margin. Base case, let's do 20%. Bullish case, let's do 23%. Now for the future PE ratio. Right now, like we said, they're trading at about a 40 to 50 PE ratio. The market's trading at about a 25 PE ratio. I think the market is a little bit overvalued in that sense. But if you take a look at the revenue growth of the S&P 500, it's still growing very fast than the past. So honestly, I don't know if it is that overvalued. But with Intuit, if we expect them to grow at about 8%, I think this company has a very good moat, to be honest. But honestly, ChatGPT and AI could potentially take over this business, but I highly doubt it. That's a very big like, I highly doubt that would happen in the future, AI taking over Intuit. But with that being said, for the future PE ratio of a company growing 8%, I think with a moat like this, let's do a 23 PE ratio. For the base case, let's do a 26 PE ratio. Bull case, let's do 29. Now for the shares outstanding, as we saw, they weren't really buying back any shares. So with that being said, for the bear case, let's say they actually increase shares. Base case, say they keep it the same, and bull case, say they buy back at 1%. With that being said, right now I think Intuit's pretty overvalued. Bear case, I think you'd make negative 11%. Base case, negative 2%. Bull case, 7.7%. So right now, I think this is overvalued. But say you think this company deserves, say, a 30 PE ratio, even a 35 PE ratio, and then say the profit margin somehow gets all the way back up to 25, I still think this company is just overvalued right now. And it's nothing against Intuit. I think this company is a pretty good company. But right now, I just think it's too overvalued for me. So thank you guys for watching this video on Intuit stock. Please subscribe, hit the like button, comment down below, and thank you guys for watching. See ya.